Hello, today is Thursday, the 12th day of September 2013, at least it is for most people watching this video. And within this, I'm going to take a look at the daily, weekly charts using my spreadsheet, which is what I use to create these. If you're asking what software do I use, well, I guess it's OpenOffice, which is a spreadsheet that's available for free within the internet, and a very decent and good spreadsheet, to say the least. After all, it's able to make these charts fairly well. This is where I get the data that I just really copy and paste and do a paint document. That's really all I do. But anyway, I want to talk about this formation, go over the weekly chart because it has a lot to do with this. And then I want to talk about $20 silver. Historical ones, because I did some nice spreadsheet data calculations, and well, I'm going to give those results at the end. But then this chart. I've talked about this 18 average of highs, lows, and closes to go in declining mode, as I don't expect that, at least not before we at least see $26 silver. This is not declining yet, but it's looking a lot closer. We've had one consecutive day where the highest level has closed below the 18 average of lows. For there to be two consecutive days, that means today on Thursday, the highest price level must stay below 23 and a quarter. If it does that, this will be day number 2 of course, staying below. Now the main thing is it's really up to about 24 mid-change down to about 22 3/4 change, around 22.75, 22.70. That's the range area where it's, even if it's in a declining or upward movement, it's really not, it's still neutral. So if I see it's declining and it's here, it's not declining in my book, it's neutral. But again, if I see significant moves breaking below 22.70, or if I see it holding and staying below there for a couple of days, at least another one and a half days more until maybe Friday at lunchtime, then a lot of concern will be had for further retracement. You got this Fibonacci line here at 22.21. That's 38.2% from this high and this low. The one below that would match up with this high. You can't see the line on here, but it is set at 20.59. And 20 is a significant area, which is really what I'm going to talk about at the end of this. Notice the pattern of how you were in a downtrend. This 18 average started to go neutral. Like I say, just because this was rising, that's not rising to me. That's neutral. The rising moving average really started in here, when it broke resistance after having the successful test. Long up move, staying above the 18 average of highs, solid bull market status. Now the correction. If you have the one move like this, and it doesn't successfully find support and goes lower, that is a large sell or spell for a failure, which is why on a down move, to me, one of three things happens. One, it stays in a choppy environment. Maybe 22 to 25 in a range, even 25 and a half, anything in that area. That's number one. Number two, start of a bear market on this time frame. Maybe you go lower, this thing starts declining, you find resistance at it like in here, and then boom, down you go. That's the second option. The third is the classic failed move, fast move. Show you an example of that weekly chart. There's the failed breakout. Notice it gets above it, and then boom, failed breakdown because it didn't break this high. So now, when we look at this today, we have this long period where it was below the 18 average of lows, and for a majority of it, it's well below the 18 average of lows. And then you have a few weeks of this sideways consolidation. Boom, you break above it. This thing has now started to rise. So now you ask yourself, A, is this thing going to go neutral and go sideways? Really, any ranges between at this stage, 18 and 25 would be that of a sideways consolidation pattern. Is it that failed breakout like in here? If that's the case, that thing could get deadly. But we're not going to talk about that, but you should already know 16 would be generous if that's all it went down to, if this was a failed breakout. Then, of course, you have the setup of breaking above, going back to this band, and then when you break above this level, boom, shakalaka. That's why in here, you go down here, and that's why some people say you don't go long in here, you want to wait till at least break it. It never happened, down she went. So that's the type of action that you're seeing, where if it does come down to this band, 21, 22 and change, maybe 4, 5, 6 weeks go by, you get like 4 to 6 green candles, 5 out of 6 green candles, and it's back to 25.20 or something. Oh, so now we see it up to 26, yeah, at that next key level. But that's the type of things that you would be looking for on the chart analysis basis. So the 3 things: choppiness, start of a new trend, failed move, and continuation of the downtrend. Those are the 3 options. Finally, I have some data here, and I made a spreadsheet. Got the dates. This is gold price, silver, the ratio, but we're really looking at the silver price for this one. And what I wanted to do is count the amount of consecutive days it stays above or below 24. And when this LBMA started in 68, I counted this as the first day. And it never got above 20 until 1979. These numbers are just getting large: 1800, 2800. 3,032 consecutive days up until December the 11th, or December the 12th, 1979. Okay, so what I've done is I've listed every single time it has switched above and below it. 3,000 consecutive days, but really every consecutive day since the US dollar began below 20, much higher than 3,000. And then on March the 17th, 1980, it concluded its 65-day streak of staying above 20. So what happened was its entire life below 20. On the first day in December that it went above 20, it stayed above that point until March, or 65 consecutive days. Then you have a little bit of choppiness, and 117 consecutive days it stayed below it. And that ended on September the 12th, 1980. So you had what was that failed bull move. Because what's interesting is you take this date, September 12th, 1980, and this final date of November the 6th, 1980. That was a period in which silver traded above and below 20. And then 6,901 consecutive LBMA trading days staying below 20. Heck, there was many days staying below 10 and 6 or 7 even. Then it traded above and below it in March of 2008. On March 19th, that was the last day it went above it, or the next day it went below, for 624 consecutive days. Not breaking above it until September 8th, 2010. Few days playing around, 4, and then 698 consecutive days from September 14th, 2010 to June 21st of this year of being above 20. And then you had 22 consecutive days below it. Since that point on July 25th, you can see that it's been above and below it. But what's interesting to note is, you can talk all you want about the Hunt brothers back in this day, but the markets have always been manipulated, and it's always been manipulated by really the same companies, banks, if you will. Now, the mechanisms to how they do things have evolved or changed within, but generally it's always been the same. So I have 2 questions, and whether it's, I don't care if they're rhetorical or not. It's up to you if you want it to be rhetorical. And that is, what was the fair value of silver, say in September of 1980? 33 years ago. What was the fair price of silver for back in this time frame? we can see here, the price of silver was like at the $2 in 1968. It went below $1.50 in 72. And then you had the bull runs, $5 silver in 75, $5 silver in 78. And then 79 came into play for $7 silver, turning into 10, turning into 16, turning into 30, turning into 50, all that type of stuff. And then, of course, there's a sell-off. And, well, now we enter the time of staying below 10 for I don't know how many consecutive days. Well, actually, I could figure it out, but I'm not going to. Then back to 17. So when we look back at this again, what was fair value in 1980 in the manipulated market? Because if the prices were manipulated then and every day, we really never have had really true value of the price or true knowledge of the value. Question is, what was the value then? How many times higher is it today? Now, some might use the analysis that, well, if silver was $1.25 in 1972 and $50 in 1980, that means $1.25 would have been way oversold or way below value for 72, and 50 would have been way above value for 1980. So in 1980, maybe fair value might have been 20 or 24 or 16. Well, let's just assume if it was 20, how many times higher is it from then to today? 4 times higher, 5 times higher, 6 times? Different things to think about. But when you really think about it, or when I'm really thinking about it, here we are pricing this in dollars, which is something that I look at via definition of counterfeit, via definition of money to be counterfeit money, and made fraudulently in a sense that guarantees this large, heavy debt burden system. So I don't know if I even want to give it any value or that of maybe negative value. Thank you for tuning in.